Tesla taking off today on the back of not one, but two big analyst calls. Number one, Morgan Stanley upping its price target on the stock. Analyst Adam Jonas laying out a new bull case scenario where Tesla could hit $1,200 a share. Morgan Stanley, though, sticking by its underweight rating on the stock. Again, it's could hit. Separately, Bernstein raising its price target on Tesla to $730 from $325. Analyst Tony Sacconaghi says it is finally time to start believing the company can sustainably be profitable. So, do we actually believe either one of these calls? I mean, and I don't want to. Morgan Stanley is not wildly bullish. They've got the super high target if certain things happen.
Yeah, I'm not sure that's a super high target the way the stock's traded over the last couple of weeks. We could reach that in a couple trading days. But I think if you look at all of these calls, it's exactly what the market has been pricing in. 6 months ago, a year ago, you thought Tesla might even go out of business. They're going to have a cash problem. They're going to have to raise money. Now they're actually profitable. And so that's what the market, that's what surprised the market. That's where we are. These calls, they're great analysts, but I think what they're looking in the rear view mirror on this. Going forward, what you have to look at is, can Tesla now make that transition into the car company that everybody thinks it is? I still think this name trades as kind of a story stock. It's more than a car company. It's an electric battery company. It's a way to play the decarbonization of the electric grid. That's why this stock trades so crazily, not because people think it's a car company, because if you value it as a car company, as everybody on this desk has said, it's way overvalued.
So if you value it like a car company, it actually is well ahead of Volkswagen if you look at 2030 and where they expect them to be. But if you listen to Adam Jonas, again, and a lot of analysts are under a lot of pressure to make adjustments to their numbers. So what Adam has done is he's taken his weighted average cost of capital, his WACC, from 13% down to 11% in his DCF. If you do that, you get significantly better numbers. And that's why sometimes people are skeptical about DCF. And he's also taken his auto deliveries by 2030 up to 2.1 or 2.2 million. I forget which number. But that ultimately, that's also a function of where the company said they were going to be. Remember, the company came in at 367,000 annual, which was the bottom end of their range. And they said we're going to be north of 500,000. So if analysts have to follow that, or if they do, they can get to some of these numbers by 2030. Obviously, I've been bearish. I've been wrong. I do think that a lot of the analysts feel the pressure to actually step in there and find a scenario where they can raise prices. And by the way, it's scenario analysis. He hasn't even, I mean, this is not what Adam does. I'm not picking on Adam. Adam's a great analyst. He comes on this show and does a great job. But the scenario analysis allows you to kind of cover yourself across the board.
By the way, the kind of an irony today in Germany, you see the Reuters news? They're Tesla's trying to build the Gigafactory 4 in Berlin, but a court halted because they're trying to cut down too many trees to build the Gigafactory, so they put a stay on because they're trying to cut down too many trees.